Don Kaufman, and you are watching TheoTrade. It is August 9th, 2016, the Theo Night video. The S&Ps are just minutes away from closing, and we are seeing, well, GroundHogs Day. It's GroundHogs Day! Yet again. But I repeat, the S&Ps right now are up, again, a staggering almost 2 points over here. The liquidity today, it's a little bit better than it was yesterday. I mean, yesterday we had like record low liquidity over here. At least we're doing over 1 million contracts in the S&P futures. But I'm kind of getting bombarded with a number of emails that obviously, if you want to take a look at the S&Ps or you want to look at the broader markets over the last couple of weeks, there is not much to say. And again, let's look after the rally. And really, when you start to come into mid-July, here we are 3 weeks in an incredibly tight range. All right, so we did pick up a couple of points last Friday in the jobs number. Nevertheless, we're absolutely in a similar range over umpteen trading days over here. So the emails that I'm getting are all along the lines of, where do I go when it's low volatility? Like, where do I go? Where do I hide? It's low volatility. First off, how low is the volatility? So quantifying it is the first thing we want to do. You know, you can go over to the SPX, and I think the SPX, really, it should resonate with you with all the products you see on your screen, whether it's Apple, whether it's Costco, whether it's Netflix and Facebook, and, you know, all the major products across the board over here are all seeing rather low implied volatility. So I use the SPX overall to get a feel for that. But no matter where you go, whether it's 1 day, whether it's 15 days, whether it's 31 days out, okay, we are at record low implied volatility. So what does that really mean? Well, if you sell options premium, okay, in theory, you're selling some of the lowest implied volatility ever recorded. I mean, there's no other way to say it. You are selling, okay, the lowest implied volatility really ever recorded. Now, granted, the VIX, historically speaking, it's gotten lower than 11. Okay, the lowest print I ever remember in memory would be in February of 2007, when it actually closed in the 9 handle. That's in the 9 range, just under 10. But for the most part, the short duration volatility here is as low as it was back then in 2007. I'm talking like the 15, the 17 day. Yeah, it picks up like a month out. Neither here nor there. If you sell options premium, okay, there's not much juice to squeeze. I mean, that's what selling premium is about, right? It's about squeezing juice. So then everybody, of course, turns around and they go, so I should be buying it. Well, yeah, in context, if you think, well, I shouldn't sell options premium, the problem with selling is right now, you know, you can sell options premium. We're in this incredibly tight range. No, this is not a Darvis box. It's just a box that I drew. But it's an incredibly tight range, which means everything that you're doing kind of falls into this same standard deviation. Whether you allocated, 3 weeks ago, whether you allocated 2 weeks ago, whether you allocated last week, whether you allocated today, it's still kind of falling. If you're selling, especially out of the money premium, you're kind of lining all your troops up, all right outside this, whether you're selling puts, whether you're selling call spreads, whether you're selling both sides of it. So all you're going to have is eventually, you'll make money. You're going to get absolutely tagged when we move. It's just not going to be worth, right? The juice is not going to be worth the squeeze. So should I go out and should I just buy options premium? Can you just randomly go out and buy puts? No, I don't think that that's going to be an effective way. Right now, I have been defaulting, and it's been kind of our go-to and marquee strategy here at TheoTrade. I'm just using these in-out spreads. Now, I don't have to display one in terms of the SPX. We'll go over to a product like Apple. And I don't care if you want to get long Apple, if you want to get short Apple. Listen, Apple is trading almost at what? Almost 109. You do something like the 110, 108 spread. Listen, this is a $2 wide spread trading for a $1 debit. Why do I like it? We'll go over and analyze the trade. Oh no, I've got a mess on my Analyze tab, and I like it. But we'll go over here and we'll analyze the trade. And the point that I want to make with this is, first of all, the risk reward. It's risk a buck to be able to make a buck, but we're only going to try to make about 55%. Here's the real reason that I really am kind of heavily stressing to you, this trade will keep you out of harm's way when the volatility does eventually explode. Let's say you did 10 contracts of this bearish trade, or you could do it bullish, neither here nor there. The trade doesn't really have any theta. That's time decay. There's no real vega exposure. That's volatility exposure, right? So this trade doesn't really have any volatility exposure, so you don't have to sit, up late at night. Oh, my volatility exposure. I sold a bunch of stuff. Yeah, and selling stuff right now is going to get yourself in deep. All right? This marketplace is going to suck people in and go, nothing's going to happen, and I'm going to sell it until something does happen. And it's going to cost you all of the premium that you collected and then some. So there's no theta, which is time decay. There's no vega, which is volatility exposure. There's no gamma, which is the rate of change of delta. There's nothing but delta. So it's a directionally biased position. So for those of you that don't mind taking a small directional stance, for instance, I think Apple could go down. Well, this is the right kind of trade to take. It's not taking any other risks. All the risks of options, I'm trying to omit. I'm trying to mitigate all the risk and just take a small directional position. And if you don't like the idea of being bearish, that's okay too. Get yourself bullish. And if you think we're going to break to the upside, do the 108, 110. Now, at a time like this, by the way, the 108, 110 spread's also trading for $1. At a time like this, undoubtedly, you're going to ask, well, what direction do I think the market's going to go? I am short, but I'm short, okay, for a little bit of a longer stance. I don't necessarily I look out a week or two and we're grinding right now. And this grinding, yeah, sure, eventually it's met with a degree of volatility. Many right now, hey, some of the top investors and traders in history, they're all short. It kind of feels like everybody in the professional trading world, okay, and everybody that knows what's going on in the business, they all seem to be short. We're all on the same side of the trade, and every one of us is wrong. Now, eventually, if you can sustain your positions enough, it'll pay off. In the meantime, okay, you trade on a day-to-day basis. You kind of have to deal with the low volatility that the market's giving you. And that's what it's about right now. It's not so much about what do I do? It's, hey, you got to basically play the hand you're getting dealt. And it's a pretty raw deal right now with low volatility. Nevertheless, you do a couple in-out spreads over here. There's the bell. A couple of in-out spreads here and there. Keep your head down. Keep your risk controlled. If you are selling premium, you have to be constrained, restrained, and sit on your hands if that's what it takes. Because those that allocate big now are going to pay big later. Think about it a little bit. Thanks everybody for joining us here at TheoTrade. I'll be back in the TheoTrade chat room all throughout the course of this week. Have a great evening. Bye-bye.